Sunday, October 5th. My name is Lucky Lillygreen, and before we get started, I want to highlight the fact that there has been a name change. Until we get official club recognition from Carnegie Mellon University and the Tepper School of Business, TSBN will now be called Weekly Finance Digest. The content will be the same, giving you all the key details of the financial events that week, in addition to deeper advice and insights into the markets through interviews, weekly specials, and analytical coverage. With that, let's begin our breakdown of the first week of October. This week has been completely overshadowed by the US government shutdown, and while I'm not going to spend time reporting on this in depth, as there are numerous reports on this topic out daily from just about every news source, here is one important idea to grasp. A report from the US Bureau of Labor Statistics was supposed to come out on Friday, giving us insights into the labor market and number of job openings. Last month, we saw a decline of job openings, adding only 22,000 jobs in August, well below the forecasts of 75,000, with unemployment nearing a 4-year high of around 4.3%. However, this government shutdown prevented the release of September's monthly jobs report, a guide that investors look to in order to inform their perception of the health of the economy. While going without this data for a month will not cause a massive amount of harm, it certainly isn't good and highlights the tricky landscape for politicians and business leaders ahead. As for concerns about a recession, labor markets are weak, but GDP growth has slowly continued to climb. Therefore, we are not approaching a recession, but continued shutdowns like this could get us there, along with other factors, of course. According to NPR, the last government shutdown in December 2018 through January 2019 cost the US around $3 billion in lost GDP. I want to emphasize the idea of thinking long-term in times like this. Obviously, the current economic situation and political landscape might not seem normal to you. However, if you look historically, this has happened before. According to NPR, since 1976, there have been 20 government funding gaps. 20, with 10 of them being official shutdowns. Furthermore, at the 2023 Berkshire Hathaway annual meeting, Warren Buffett told the audience, quote, "You know, my dad was in Congress back in the 1940s, and it looked like a mess then, although it was unified by the war to some degree," end quote. This comment highlights that there have always been challenges in the US political system. This is not to dismiss what is happening right now, but just to demonstrate that we have never been more clued in to the inner workings of government struggle than we have right now. The technology of today's world lets us see conflict up close and often. This might heighten fears and allude to the perception that things are not normal. Yet each decade has its own onslaught of problems. The challenges will always be here, always. It is not a question of will they arise, it is what do you do when they arise. And in periods like this, I do what all good investors do, and that is look to Warren Buffett. What will he do in the event of an economic slowdown? What will he do if the US falls into a recession? What types of businesses will he buy and when? Let's look at what he has been doing. We know he has been exercising patience. Berkshire Hathaway has $340 billion of cash at the end of June, and he is waiting for the right opportunity to deploy this capital. It has been a struggle for Berkshire to find undervalued opportunities that move the needle, as the company is much bigger today than when Warren Buffett first started out. In fact, at this year's meeting, Buffett noted, quote, "Size is the enemy of performance at Berkshire. I don't know of any good way to solve that problem," end quote. However, exercising patience and acting at the critical time has helped Buffett's performance over the years, and it is what we continue to see from him. In fact, on Thursday, he just bought Occidental Petroleum, ticker OXY, petrochemical business, in a $9.7 billion deal. OXY trades at $44.85, and its CEO, Vicki Hullab, said the company will use a proportion of the cash to pay down debt and begin its share repurchase program. The acquisition helps Berkshire by adding to its chemical portfolio and provides them with a resilient, cash-generating business. OxyChem produces chemicals such as chlorine, caustic soda, calcium chloride, vinyl chloride, and polyvinyl chloride, which are used in the manufacturing of plastics, water treatment solutions, medical supplies, and chemicals for swimming pools. This deal exhibits the power of patience and the amount of opportunities that come up in times of economic or political distress. Buffett shared a laugh with Charlie Munger during Munger's last shareholder meeting in 2023 when Warren said, quote, "Charlie likes to tell me all the time how gloomy the world is, but there will always be opportunities," end quote. If there was one thing I learned from spending my summer working for one of the best value investors of all time, Mario Gabelli, it is that change is good. It creates opportunities and adds value over time. Now let's explore some of these possibilities together. Nike and Vail ski resorts reported earnings this week, and instead of just looking at the surface level, let's dive in like a true analyst and look at the details. Nike, ticker NKE, trades at $71.93 and reported fiscal year 2026 Q1 earnings on Tuesday. The company's stock is down 13% since this time last year and faces headwinds such as tariffs. Although revenues came in at $11.7 billion, up 1% from last year. Gross profit declined 6%, and gross margin now sits at 42.2%. Net income was down 31% at $0.7 billion, and diluted earnings per share was 49 cents, a decrease of 30%. Nike is known for paying dividends, and the company did deliver, always a good sign, with dividends up 6% from the previous year. In addition, they have paid down 100% of their short-term debt. Nike has themselves in a bit of a predicament with increased competition from other footwear brands as well as tariff costs. Vail Resorts, ticker MTN, reported fiscal year 2025 Q4 and full year results on Monday. The company reported weak earnings as they missed estimates for revenue growth and sold fewer ski passes than anticipated, a key factor of their business model. Sales of its signature Epic Pass were down 3% for the upcoming winter season. They touched on the change in leadership that occurred in May of 2025. CEO Kristen Lynch stepped down and was replaced by her predecessor, Rob Katz, who ran the organization from 2006 through 2021. Her last day was September 26, 2025, and was terminated without cause, a tactic used by companies to let go of someone without needing to specify a reason to point to. The previous CEO, Katz, saw the company's stock grow from $30 to $300 per share during his tenure as CEO. In contrast, during Lynch's time as CEO, the stock plummeted from $370 a share to $140 over a 4-year period. Whether this is due to her leadership or overall decline in ski visits from U.S. consumers, we don't know. However, both Nike and Vail are consumer-oriented stocks that are struggling, highlighting the challenging environment for consumers. Things to look out for next week include Big Pharma and how this trend will continue to be shaped under President Trump. This week, Pfizer was up the most in 20 years, a turning of the tide for health companies. Next week, Constellation Brands, Spire, McCormick, Pepsi, Delta, Levi's, and Apogee are all due to report earnings. Thank you so much for joining us. I'm Lucky Lillygreen, and that concludes our first episode of Weekly Finance Digest for October. We are also off for the next 2 weeks for fall break.